Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor, Mark Struthers, takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address not just the financial part of retirement, but also the social, the physical, and the emotional parts of retirement. Everything you need for a healthier, a wealthier, and a happier retirement. Here is your host, Mark Struthers.
Welcome to the Healthy and Wealthy Retirement. My name's Mark Struthers. I'm your host. And today we're talking taxes, not 2024 taxes, but 2026. The reason being our tax code could change. The TCJA, the Tax Code and Job Act, is set to expire. So from 2017-18 is set to sunset. And normally sunsets are beautiful. They're gorgeous, they're fun to watch, either by yourself or with that special someone or someone's. But in this case, it's probably not the best, probably not the most enjoyable thing. So they're not going to be the sunset that a lot of you are watching now in Cabo. Also, an FYI, stay alert. We're assuming that the act is going to expire, it's going to sunset. We don't know for sure. So please, before you act, take some time, understand what you're getting, what you're giving up, the risks, and make sure you stay on top of this as far as what can change and when. Unfortunately, if anything's done, as with most things with our government, it'll probably be at the last minute. So for today, we're going to highlight some of the changes, and especially from someone who's about to retire or retiree's perception. So individual income tax rates are probably going up for most of you. The standard deduction is probably going to be cut in half. Personal exemptions come back, but overall, most people are going to be worse off. The child tax credit could change. The 20% pass-through deduction for certain types of businesses, a QBI deduction, that could go away. Estate planning, the lifetime exemption amount could go down, and I know this is a lot. We're going to cover these a little bit here as soon as I get through this list. Charitable giving goes from your ability to contribute decreases. Instead of 60% of AGI, it goes down to 50%. The one good thing is the cap on state and local taxes could go away. That $10,000 cap, especially in high tax states like New York, California, Minnesota. So that's actually a good one. That's a good one for most people. For the individual tax rates, most people are going to see theirs probably go up. When I take a look at what the tax code is and what it could go to, and keep in mind when you see these ranges of incomes, the tiered brackets, these change each year. So don't get too hung up on the exact number, kind of know where you're at. But to give you some examples, a married filing jointly currently in the $275,000 to $365,000 bracket, their marginal rate could go from 24% to 33%. That is a pretty big jump. And there also could be some big surprises for those in the not so high tax bracket. So as an example, someone today who makes $350,000 is in the 24% bracket. In 2026, someone who makes $100,000 would be in the 25% bracket. So you could see that for most people, they're going to probably see their taxes go up. Not to mention, if you're in the very high tax bracket, that is going to increase as well. Most of the studies I see show that the typical American would pay an extra 1% to 4% in taxes. And I think those of you in certain tax brackets, and especially higher ones, I think you could definitely get up in the 4 to 7, 4 to 8%. That's a lot. Estate planning is the other main piece that that's going to affect most people. So income tax brackets, and then estate planning. So right now, the lifetime exemption amount is around $13 million. We're rounding $26 million per couple. Very few cases where folks are going to be above that, where they would be hit with an estate tax. But especially if you have a family farm, there could be. But that could be cut in half. So instead of $26 million, you're down to 13, and especially a small business owner, or a lot of folks, if they, even if you're kind of a typical manager or executive, or you save quite a bit, if you look at the growth of your assets in 20, 30 years, even if you adjust this $13 million for inflation, this could impact. Pull income forward. Now, keep in mind when you do this, you got to make sure the tax code, you realize the tax code might not change. Make sure, as my grandpappy used to say, the juice is worth the squeeze. So if you are able to pull income forward, most of you who have W-2 incomes cannot, but do it. Or you could do Roth conversions. If you're concerned about those IRA, those 401k taxable distributions in retirement, especially once the RMDs start and they increase required minimum distributions, you could do Roth conversions. Pay the tax now, don't worry about it, or play later. And again, keep in mind, we don't know for sure that these changes are going to happen. So I would not act unless you really got a good grasp on the benefits and the risks. Quite often when I see folks do something like this with regards to the tax code change, they're doing it where they were on the fence before. Maybe they just, Roth conversions, oddly enough, are often good for even those in some fairly high tax brackets, but a lot of folks just don't like it. They just don't like the concept, and they're, in many ways, they're afraid, well, what if I die before I get to take advantage of that Roth conversion of those lost tax dollars? Maybe they don't care about the impact on their heirs. It's understandable. Where this might push them over to say, yep, doing these Roth conversions is a good idea. Related to Roth conversions, you could even say, I'm going to do Roth contributions now. I'm going to pay what I think is a lower tax now compared to what it could be in the future. One thing to keep in mind, though, anytime you are moving income forward or increasing your income, is the unintended consequences. That you might lose out on things like the ACA healthcare exchanges. You might lose out on that credit, or even being on I see a lot of folks who are on Medicaid or Minnesota Care, even though they have several $1 million in assets, and you can be the judge of whether that should be taken into account. But that being said, that they would be kicked off, or folks who don't have a lot of assets still might be kicked out of the Minnesota Care or ACA or Medicaid if they were to increase their income, or they'll lose out on those tax credits or have to pay the tax credits back. Other credits or deductions, or rebates. In Minnesota here, the property tax rebate's a big one. So before you move income around, this is where you do need to run scenarios ideally and say, what credits or deductions am I going to miss out on? Am I going to miss out on any rebates? Keep in mind, also, if you do increase income, your Social Security could be taxed, Medicare premiums could increase, and circling back to some of those other taxes, even the net investment tax, things like capital gains could be, or dividends could be adversely affected. As with any financial planning decision where you're trading things today for possibilities in the future, ideally run scenarios, kind of see what your tax rate might be in the future with Social Security, pensions, distributions, or especially required minimum distributions. And that way you get a good feel for what you're getting. If I'm taking more income now, assuming things don't sunset, or even, what's the risk in the future if I don't do this? From an estate planning perspective, increase giving, both charitable and gifting to maybe family members. You could start doing more if start doing maybe at least the year-to-year gift tax exclusion amount. I think it's $18,000 now. So $18,000 per couple, so $36,000. So you could give away a lot of money, assuming that's the right thing to do. Obviously, if you're giving it to kids, That can be dangerous, but you could start gifting. You could certainly start using trusts or ways that maybe limit access to it. 529 plans, not a horrible way to do it, because you could even still have control of the assets. Now, again, there's lots of pros and cons and nuances around this. From charitable giving standpoint, again, if you're concerned about the percent of AGI going from 60 down to 50, you could start giving more now. You could reevaluate your business structure when it comes to that 20% pass through. If that goes away, might make sense to reorganize as a C corp. All depends on your business and your own personal situation. Again, this is where you kind of run scenarios. You say, what does this look like under these different environments? And lastly, just a reminder to stay alert that we're talking about something that might happen. We don't know for sure it will. So I would not go out there just without putting some thought into it and start doing Roth conversions or moving income or gifting a bunch of assets away. I would make sure you spend some time running the numbers, talking about it, and being aware of the pros and cons. Because financial planning is all about making an informed decision. And when you make informed decisions, you have a better chance of having a healthier, a wealthier, and a happier retirement. Don't forget to hit subscribe.